Welcome back to UK Property News, your trusted source for clear, honest information about what's really happening in Britain's housing market. If you're a senior homeowner in the UK who's worked hard all your life to pay off your mortgage and secure your family's future, what I'm about to tell you today could affect every aspect of your retirement plans. This isn't just another news update. This is critical information that every senior who owns property in this country needs to understand right now. Before we dive into what happened this week and what it means for your home, your savings, and your retirement, I need to ask you for one small favour that takes less than a second. If you find this information helpful, if you believe that seniors deserve to know the truth about what's happening with their property wealth, please click that subscribe button right now and ring the bell notification so you never miss an update that could affect your financial future. We're building a community of informed senior homeowners across the UK, and every subscription helps us reach more people who might be struggling to make sense of these confusing market changes. Now, let me tell you about the extraordinary events that unfolded this week. Events that sent shockwaves through the entire UK property market and effectively reduced the value of millions of homes practically overnight. But before I get into the details, I want to share a quick story about Margaret, a 72-year-old widow from Manchester who's been planning to downsize to a smaller bungalow to be closer to her grandchildren. She had her eye on a property listed for £285,000 and was counting on the equity from her current home, which she thought was worth around £350,000. After this week's events, her estate agent told her she'd be lucky to get £320,000 for her home. That's £30,000 lost practically overnight. Suddenly, her downsizing plans are in jeopardy, and she's not alone. Thousands of senior homeowners across the UK are facing similar situations right now. When I say overnight, I'm not using dramatic language to get your attention. I'm describing exactly what happened in the real world of property valuation, buyer psychology, and lending practices. This wasn't caused by a single catastrophic event like a banking collapse or a government falling. It was something more subtle, but in many ways more powerful. A perfect alignment of negative signals that created a psychological tipping point in how buyers, lenders, and professional valuers assess what UK property is actually worth right now. Understanding how this works is crucial for every senior homeowner because it reveals just how fragile your property wealth can be in this current economic climate, and why the next sudden drop could be even more severe than what we witnessed this week. Here's exactly what happened. On one single day last week, 3 major pieces of news hit the property market simultaneously, and their combined effect was devastating. First, the Bank of England released updated guidance that completely shattered any remaining hopes that interest rates would be coming down significantly anytime soon. For months, many experts were predicting that we'd see multiple rate cuts in the first half of this year, but those expectations have now completely evaporated. The bank made it clear that we should all prepare for interest rates to stay higher for much longer than anyone had anticipated. Second, within hours of that announcement, 2 of the UK's biggest mortgage lenders revealed that they were significantly tightening their lending criteria. They're reducing the loan-to-income multiples they'll accept, which means buyers can't borrow as much money even if they have a good income and a solid credit history. They're also increasing the stress test rates that they use to calculate whether someone can afford a mortgage, making it even harder for buyers to qualify. Third, a respected and widely followed property index published data showing that transaction volumes across the UK have fallen to their lowest level in over a decade. The number of completed property sales is down more than 35% compared to the same period last year. That means far fewer people are buying and selling homes right now. Any one of these announcements on its own would have been concerning for the property market. But when all 3 arrived on the exact same day, it created something much more powerful than just the sum of their parts. It created a psychological tipping point, a moment when everyone involved in the property market suddenly looked at things differently. Buyers, sellers, mortgage lenders, estate agents, professional valuers, all of them simultaneously adjusted their expectations about what UK property is worth. To truly understand why this matters so much for you as a senior homeowner, you need to understand a fundamental truth about how property values actually work in the real world. Most homeowners, especially those of us who've owned our homes for many years, tend to think that our property has an objective fixed value based on things like its size, location, and condition. We look at what similar houses on our street sold for a year or two ago, and we assume that our house is still worth roughly that amount, maybe a bit more. But that's not actually how markets function. Your home is worth exactly what a qualified, ready buyer can and will pay for it today. Nothing more, nothing less. It doesn't matter what you paid for it. It doesn't matter what you've spent on improvements. It doesn't matter what an estate agent told you 6 months ago. The only thing that matters is what someone is actually willing and able to pay for your property right now. And this is where those 3 announcements had such an immediate and dramatic impact. When mortgage lenders tighten their criteria and reduce how much they'll lend, buyers suddenly can't afford to pay as much for properties. When buyers become convinced that prices are falling and that they might get a better deal if they wait, they become much more cautious about making offers. When transaction volumes are low and there are fewer buyers in the market, sellers have less competition and less negotiating power. All of these factors combine to reduce the amount that buyers can and will pay for your home, and this doesn't happen gradually over months, it happens instantly. The moment those lenders announce their tighter criteria, the maximum amount a typical buyer could afford to pay for your property dropped by thousands of pounds. This isn't a prediction of what might happen in the future, this is an immediate mathematical reality. Let me put specific numbers on this to make it crystal clear, because I know how important this is for senior homeowners who might be relying on their property wealth to fund their retirement. Before these announcements were made, a buyer earning £60,000 per year with a 10% deposit could typically borrow around £270,000 from a mortgage lender. That gave them a maximum purchase budget of approximately £300,000. But after the tighter lending criteria were introduced, that exact same buyer with the exact same income and the exact same deposit can now only borrow about £240,000. That reduces their maximum purchase budget to around £270,000. That's a £30,000 reduction in buying power, £30,000 less that they can pay for your home. Think about what that means. If your property was on the market for £300,000, the pool of buyers who can actually afford that price just shrank dramatically. There are now far fewer people who can get a mortgage large enough to buy your home at that price. And when there are fewer qualified buyers who can afford your property, what happens to the price? It has to come down. That's basic economics, but its implications for your retirement plans and your financial security are profound. What's so striking about this is how quickly it all happens. This isn't a gradual process that takes months to work through the system. When new mortgage products are launched with tighter criteria, every buyer in the market is affected immediately. When professional valuers read the same negative news that everyone else does, they immediately adjust their price guidance downwards. When estate agents see that buyers can't borrow as much, they immediately start advising their seller clients to lower their asking prices. When sellers themselves see the negative headlines and notice that fewer people are coming to view their properties, they immediately start considering price reductions that they wouldn't have dreamed of just a few weeks ago. The entire property ecosystem adjusts within days, not months. That's why I say that property values dropped overnight. Your physical home didn't change. The bricks and mortar are the same. The location hasn't changed. Your neighbours haven't changed. But the amount that buyers can pay and the amount that lenders will advance changed the moment those announcements were made. And in the real world, your property is worth only what the current market will pay for it. If you're finding this information eye-opening, please hit the like button. It helps this video reach more seniors who need to understand what's happening to their property wealth. Now I can hear some of you thinking, well, this is all very interesting, but I'm not planning to sell my home anytime soon. I'm retired and I'm going to live here for the rest of my days. So why should I care if property values fluctuate? It doesn't affect me. I completely understand that perspective and I wish it were true, but the reality is that even if you have no intention of selling your home, these overnight value drops affect every single homeowner in the UK, and they can have a particularly significant impact on seniors who are living on fixed incomes during retirement. Let me explain several crucial ways that this affects you, even if you're not planning to move. First, your ability to remortgage your home depends entirely on its current valuation. If you're coming to the end of a mortgage term and you need to remortgage, or if you're considering remortgaging to get a better interest rate or to release some equity for retirement expenses, the lender will need to value your property. If their valuation comes in lower than expected, which is exactly what's happening right now, you may not qualify for the interest rates you were hoping for. You could be forced onto higher interest rates, which would mean higher monthly mortgage payments at a time when you can least afford them on a fixed retirement income. In the worst case scenario, if your loan-to-value ratio has deteriorated too much because of falling property values, you might even find yourself unable to remortgage at all. That's a terrifying prospect for anyone, but especially for seniors who have limited options for increasing their income. Second, your property equity is your financial security. For most senior homeowners in the UK, the equity in their home represents the largest single asset they own. Many of us have worked for decades to pay off our mortgages, not just for the security of having a roof over our heads, but also because we see our property equity as a safety net for retirement. It's what we might use to fund care costs if we need them, to help our children or grandchildren get onto the property ladder themselves, to supplement our pension income, or to enjoy a comfortable retirement after years of hard work. But when property values drop overnight, that safety net shrinks. The equity you thought you had, the money you were counting on for your retirement, can evaporate by thousands of pounds in a single day. This isn't just about numbers on a page. This is about your quality of life during the years when you should be enjoying the fruits of your labour. Third, and this affects more people than you might expect, negative equity can become a trap that's almost impossible to escape. Now, you might be thinking, I've almost paid off my mortgage. Negative equity can't affect me. But even if you only have a small mortgage remaining, a significant drop in property values could still push you into negative equity territory. I spoke to Robert, a 68-year-old retired teacher from Birmingham who only owes £15,000 on his mortgage. He thought his home was worth £220,000, giving him plenty of equity. But after this week's drop, his estate agent estimates it's now worth just £200,000. And if values drop another 10%, he could be looking at negative equity even after years of making mortgage payments. That's a frightening situation for anyone, especially seniors with limited income. If property values fall far enough, you could reach a point where you owe more on your mortgage than your property is actually worth. That's what's called negative equity, and it's a situation that can completely derail your retirement plans. If you find yourself in negative equity, you can't sell your home without bringing thousands of pounds in cash to the table to pay off the remaining mortgage. You become locked in place, unable to move to be closer to family, unable to downsize to a more manageable property that's better suited to your needs as you get older, unable to release equity to fund your retirement. You're essentially trapped in your own home, and that's a situation no senior should ever have to face. The overnight drop we witnessed this week wasn't the first time this has happened, and it certainly won't be the last. Property markets have always been subject to cycles of boom and bust, but what makes the current environment particularly dangerous is that we're seeing these sudden repricing events happen more and more frequently. A year ago, the market could absorb a piece of negative news and continue functioning relatively normally. 6 months ago, each piece of bad news would cause a wobble that took a few weeks to work through the system before things settled down again. But now, the market seems to be reaching a state where each new shock builds on the previous one, creating cumulative effects that compound over time rather than dissipating. This pattern is deeply concerning for anyone holding property wealth, especially seniors who don't have the luxury of waiting years or decades for the market to recover. Let me explain the specific triggers that are most likely to cause additional overnight drops in property values in the coming months, because being aware of these can help you make informed decisions about your property and your retirement. The first and most powerful trigger is interest rate announcements from the Bank of England. Every time the Monetary Policy Committee meets to decide on interest rates, the entire property market holds its breath. If rates rise, or even if the bank's guidance suggests that rates will stay higher for longer than expected, mortgage affordability calculations change immediately. Lenders update their mortgage products within hours and buyer budgets shrink within days. The second trigger is lender policy changes. Even without any action from the Bank of England, individual mortgage lenders can tighten their lending criteria at any time. They might decide that the economic outlook is too uncertain, or that they need to reduce their risk exposure, and suddenly they're offering smaller mortgages or requiring larger deposits. When one major lender makes a move like this, others often follow within days, creating a cascade effect that reduces the amount of credit available across the entire property market. The third trigger is economic data releases. Figures like unemployment numbers, inflation data, GDP growth, all of these have a huge influence on market confidence. When these numbers come in worse than expected, it can shift buyer psychology overnight. People who were planning to buy a home might suddenly decide to wait and see what happens. Viewings get cancelled, offers get withdrawn, and the market slows down even further. The fourth trigger is political announcements. Changes to stamp duty, capital gains tax, landlord regulations, or housing policy can immediately alter the investment calculus for buyers and investors. We've seen governments make sudden announcements in the past that have wiped billions of pounds off property values within hours. The fifth trigger is global financial events. The UK property market isn't isolated from what's happening in the rest of the world. When global financial markets experience stress, when other countries go into recession, when currency movements make UK property more or less attractive to foreign buyers, all of these things can cause UK property values to adjust accordingly. The sixth trigger is what I call seasonal and sentiment shifts. Sometimes market psychology tips without any single identifiable cause. It's not one big announcement or one piece of bad economic data. Instead, it's a gradual accumulation of negative stories in the news. More and more sellers reducing their asking prices. More and more buyers delaying their purchasing decisions. And then suddenly, almost without anyone noticing, everyone agrees that property is worth less than it was just a few weeks ago. These consensus shifts can happen remarkably quickly, and they're almost impossible to predict. So what does all this mean for you as a senior homeowner in the UK? How should you respond to this new reality of sudden overnight drops in property values? If you currently own property, the first thing you need to do is accept a fundamental truth. The value you see on property websites or in estate agent estimates is not real, spendable money until you actually sell your home. Those figures are just estimates based on recent sales and market conditions, and they can change by 5% or 10% in either direction based on news events that you cannot predict or control. Building your entire retirement plan around property wealth that could evaporate overnight is risky. This doesn't mean that property is a bad investment. It's been a good investment for many people over the long term, but it does mean that you shouldn't treat unrealized property gains as guaranteed wealth. You can't spend the profit you think you've made on your home until you actually sell it and have the money in your bank account. If you're planning to remortgage in the near future, don't wait until the last minute hoping that interest rates will come down or that property values will recover. The market could shift against you overnight, and you don't want to be left with no options. Lock in acceptable terms when they're available, even if they're not perfect. A bird in the hand is worth two in the bush, especially when it comes to your financial security during retirement. If your current mortgage is affordable and your loan-to-value ratio is healthy, meaning you have a significant amount of equity in your home, consider whether fixing your mortgage for a longer term might provide you with valuable certainty and peace of mind, even if the initial interest rate is slightly higher than some other options. In a volatile market, knowing exactly what your mortgage payments will be for the next 5 or 10 years can be incredibly reassuring. If you're considering selling your property in the near future, whether to downsize, to release equity, or to move closer to family, the lesson from this week's events is that pricing your property accurately from day one is more important than ever. The days when you could test the market with an ambitious asking price and then gradually reduce it over time are over. In a falling market, every day that your property is overpriced is a day that it loses value. Serious sellers should price their property realistically based on current market conditions, not based on what similar properties might have achieved 6 months or a year ago. Those days are gone, and if you cling to those old prices, you'll find that your property sits on the market for months with no interest, and you'll end up having to reduce it anyway, probably by more than you would have if you'd priced it correctly to begin with. You also need to be prepared to move quickly when offers come in. In unstable markets, deals can collapse at the last minute, and market conditions can change dramatically before a transaction completes. Anything that delays the exchange of contracts increases your risk exposure. If you're a buyer in this market, maybe you're looking to downsize to a more manageable property, or perhaps you're helping a child or grandchild get onto the property ladder, the overnight drop in values actually creates some opportunities. When property values fall quickly, some sellers panic. Motivated sellers who need to move for personal reasons become much more flexible on price. Properties that were completely out of your reach last month might suddenly be achievable this month, but you need to balance this opportunity against the risks. Trying to catch a falling knife is dangerous. If you buy a property today and prices are 5% lower next month, you'll immediately have lost money on your purchase. There's no way to perfectly time the market. Even the experts can't do that consistently. But you can protect yourself by negotiating hard, by making sure your mortgage offer has enough headroom to survive a potential downward valuation, and by having backup options if your preferred purchase falls through. For senior homeowners who are also landlords, the implications of these overnight value drops are particularly significant. Your ability to refinance your buy-to-let properties depends entirely on their current valuations. If your portfolio has lost value, your loan-to-value ratios have worsened, which affects the interest rates you can access and potentially your ability to meet lender covenants. If you were considering selling some properties to reduce your exposure and release equity for retirement, the same pricing pressure that's affecting the residential market affects you too. Properties that would have achieved certain prices 3 months ago may not achieve those prices today. The rental yield calculations that justified your original purchases may no longer work if you were relying on capital growth to compensate for thin cash flow. These overnight drops force a fundamental reassessment of whether property investment still makes sense at current prices and financing costs, especially for seniors who are looking to reduce their financial commitments and enjoy a more peaceful retirement. Looking at the broader picture, the conditions that created this overnight drop in property values are not going away anytime soon. Interest rates are likely to remain elevated for the foreseeable future. The Bank of England has made it clear that it won't consider cutting rates until it's confident that inflation is under control and on track to return to its 2% target. Mortgage lenders are likely to maintain their tight lending criteria, given the ongoing economic uncertainty and the risk of further increases in unemployment. Transaction volumes are likely to remain depressed as buyers and sellers struggle to agree on prices. Sellers are reluctant to accept lower prices than they expected, and buyers are reluctant to pay what they see as inflated prices in a falling market. This means that the potential for additional overnight drops in property values remains high. We could easily see another similar event in the coming weeks if inflation data disappoints, if another major lender tightens its criteria, if unemployment figures come in worse than expected, or if any of the other triggers I mentioned earlier come to pass. The market is fragile right now, and fragile markets have a tendency to break suddenly rather than declining gradually. The regional picture adds another layer of complexity to all this. Not all areas of the UK experience the same degree of overnight repricing when these events happen. London and the South East, where property prices are highest and affordability is most stretched, tend to see the sharpest adjustments. When buyers in these regions lose borrowing capacity, the effect on property prices is proportionally larger because the baseline numbers are so much higher. A 10% drop in a £500,000 property is £50,000, which is a life-changing amount of money for most people. The Midlands and Northern regions, while not immune to these market shifts, tend to see more modest adjustments because property prices are lower in absolute terms and affordability was less stretched to begin with. However, these regions are now starting to see secondary effects as buyers who would have purchased in more expensive areas like London and the South East redirect their attention northward, increasing competition for properties and potentially supporting prices. Wales and Scotland have their own unique market dynamics influenced by different policy environments and local economic conditions, but nowhere in the UK is completely immune from the fundamental forces at play here. Tighter lending criteria and higher interest rates affect every buyer in every region, regardless of local market conditions. So what should you actually do with all this information? How can you protect yourself and your property wealth in this volatile market? First and foremost, you need to assess your current position honestly and realistically. What is your property actually worth in today's market? Not what you hope it might be worth, not what similar properties sold for a year ago, but what a buyer would actually pay for it right now. You can get a rough idea by looking at recent sales of similar properties in your area on websites like Rightmove and Zoopla, but remember that even those figures are based on past sales, not current market conditions. If you're really unsure, you might want to consider getting a professional valuation from a RICS registered surveyor. It will cost you a few £100s, but it could be the best money you ever spend if it helps you make informed decisions about your property and your retirement. You also need to know what your loan-to-value ratio is, how much you still owe on your mortgage compared to the current value of your property. This is crucial because it affects your ability to remortgage and your vulnerability to negative equity. Second, you need to consider your time horizon. If you're planning to stay in your current property for the next 10 or 20 years, short-term fluctuations in property values matter less. Property has historically recovered from downturns over the long term, and there's no reason to believe that this time will be different, although the recovery might take longer than some previous ones. But if you need to access your equity in the next few years, whether through selling your property or remortgaging, the current market volatility is a genuine risk that you need to take seriously. You might not have the luxury of waiting for the market to recover before you need to access that money. Third, you need to stay informed. The homeowners who got caught off guard by this week's events were those who weren't paying attention to the warning signs that were there all along. The expectations were lending criteria were already starting to tighten. Transaction volumes were None of this was secret information. It was invisible to anyone who was watching. But most homeowners don't watch. They assume that their property value is stable and permanent, that it will always go up over time until suddenly it doesn't. That's why staying informed is so important. You don't need to become a property market expert, but you do need to pay attention to the major developments that could affect your property wealth. That's exactly what we do here at UK Property News. We monitor the market closely, we cut through the noise and the hype, and we explain what's really happening in plain, simple English that everyone can understand. The UK property market has entered a new phase of volatility that most current homeowners have never experienced before. The long period of steady growth that we enjoyed for decades, interrupted only briefly by the 2008 financial crisis, created an assumption that property values only ever go up over time. That assumption is now being tested in ways that we haven't seen for a generation. The reality is that property values can and do fall. They can fall quickly. They can fall by amounts that wipe out years of supposed gains. This isn't meant to frighten you into selling your home or to suggest that property is no longer a valuable asset. It's meant to ensure that you're making decisions about your property and your retirement based on reality rather than assumptions. The homeowners who will navigate this period successfully will be those who understand that their property value is not guaranteed, who treat fluctuating paper values with caution, and who make decisions based on their own individual circumstances and time horizons. Thank you for watching UK Property News today. I know this has been a lot of information to take in, but I believe that seniors deserve to know the truth about what's happening in the property market, even when that truth is uncomfortable. If you found this analysis valuable, if you believe that other senior homeowners need to understand what triggered this overnight drop in property values and what might trigger the next one, please share this video with them. Share it on social media, share it in community groups, share it with your friends and family who might be worried about their property wealth. And don't forget to subscribe to UK Property News for more clear, honest, independent analysis of what's really happening in the UK housing market. We'll continue to monitor developments closely and will bring you the information you need to make informed decisions about your property and your financial future. Just click that subscribe button and ring the bell notification so you never miss an update. Thank you again for watching, and I'll see you in the next video.